Imagine you just got your tax refund or maybe a bonus check from work, and you're sitting there staring at an extra $2,000 in your checking account. You know you should invest it. You've been telling yourself you're going to start investing for the past 3 years, but every time you open up one of those investing apps, you freeze. Do I buy index funds? Do I need a Roth IRA? What about a 401k? Should I wait for the market to crash? And then 2 months later, that money is somehow gone, spent on rent, groceries, that weekend trip you convinced yourself you deserved, and you're back to square one, promising yourself that next time you'll actually do it. If that sounds painfully familiar, this video is for you. My name is Guy, and I spend way too much time thinking about why smart people make terrible financial decisions. If you're someone who knows they should be investing but keeps putting it off because you're overwhelmed, confused, or convinced you need to understand everything before you start, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. If I were starting from absolute zero in 2026, knowing everything I know now about investing, personal finance, and how wealth actually gets built, I would do things very differently than what most financial gurus tell you to do. And I'm going to walk you through the exact step-by-step strategy I'd follow, the specific dollar amounts I'd use, and more importantly, why this approach works when so many other strategies fail. Look, the reason most people never start investing isn't because they don't have money. According to a 2024 survey by Bankrate, 56% of Americans who aren't investing say it's because they don't know enough about it, not because they're broke, because they're paralyzed by information overload. And I get it. The financial industry has done an absolutely terrible job of making this simple. They've created this perception that investing is this complex, sophisticated thing that requires you to understand price to earnings ratios, read quarterly reports, and watch CNBC for 4 hours a day. And that's complete nonsense. Here's what most people don't realize. The difference between someone who retires with $2 million and someone who retires broke often comes down to a handful of decisions they made in their 20s and 30s. Not complicated decisions, simple ones. But they have to actually make them. So let me show you exactly what I do. Step 1, the foundation. The very first thing I would do before I invested a single dollar is build what I call a starter emergency fund of $1,000. Not 3 months of expenses, not 6 months of expenses, $1,000. Now, you might be thinking, wait, I thought emergency funds were supposed to be way bigger than that. And yes, eventually, but here's the problem with telling someone who's never invested before that they need to save up $15,000 before they can start investing. They never start investing. I've seen this play out hundreds of times. Someone gets motivated, they start saving, they hit about $2,000, then their car breaks down, or they have a medical bill, or they go on vacation, and boom, they're back to zero. And the psychological damage from that is massive. They feel like they failed, they feel like they're never going to get ahead, and they give up. So instead, you save $1,000 as fast as humanly possible. You put it in a high-yield savings account, earning around 4 to 5% interest, which is what many online savings accounts offer right now in 2026. You don't touch it unless there's a genuine emergency. And the second you hit that $1,000 mark, you start investing. This is where it gets really interesting, because conventional wisdom says you should have your full emergency fund before investing. But the math says something different. Let's say you're 25 years old. If you wait 1 full year to save up a complete emergency fund before you start investing, and you were planning to invest $300 a month, you've just delayed investing $3,600 at an average annual return of 10%. By the time you're 65, that 1 year delay costs you over $158,000. 1 year of waiting, $158,000 gone. That's the real cost of perfectionism. Step 2, the 401k match. Okay, so you've got your $1,000 emergency fund. Step 2 happens simultaneously. If your employer offers a 401k match, you contribute enough to get the full match immediately. Not next year, not when you understand the investment options better, immediately. Here's why. A 401k match is the only true free money that exists in personal finance. If your employer matches 50 cents on the dollar, up to 6% of your salary, and you're making $50,000 a year, that's $1,500 of free money every single year. That's a 50% return on your investment before the market does anything. Show me any other investment that guarantees you 50% returns, and I'll show you a scam. The 401k match is the exception. Now, I know what some of you are thinking, but Guy, I don't understand the investment options in my 401k. I don't know if I should pick the growth fund or the balance fund or the target date fund. Here's my answer. Pick the target date fund closest to when you turn 65 and move on with your life. Target date funds automatically adjust from aggressive to conservative as you get older. They're diversified, they're simple, they're not perfect, but perfect is the enemy of good, and good is what gets you wealthy. Step 3, the Roth IRA. Once you're getting your full 401k match, step 3 is opening a Roth IRA and contributing as much as you can up to the annual limit, which is $7,000 in 2026 for people under 50. The Roth IRA is, in my opinion, the single best investment account for most people building wealth. And here's why. You contribute after tax dollars, meaning you already pay taxes on that money, but then it grows completely tax-free, and when you retire, you pull it out tax-free. Let me show you how powerful this is with real numbers. Let's say you're 25 and you max out your Roth IRA every year for 40 years. That's $7,000 a year. At a 10% average annual return by age 65, you'd have $3.4 million. And here's the kicker. If that were in a traditional retirement account, you'd owe taxes on every dollar you pulled out. At a 24% tax rate, that's over $800,000 in taxes. With a Roth IRA, you pay zero. Now, look, I know $7,000 a year sounds like a lot. If you're just starting out, you don't have to max it out immediately. But here's what I'd do. I'd set up automatic contributions of whatever I could afford, even if it's just $200 a month, even if it's $100 a month. The key is automation. Here's what most people don't realize about automation. It removes willpower from the equation. You're not sitting there every month deciding whether to invest or spend. The money moves automatically. You adjust your lifestyle to what's left, and within 3 months, you don't even notice it's gone. There's a psychological principle called loss aversion. We feel losses about twice as intensely as we feel gains. So when you manually transfer money to investments, it feels like a loss. But when it happens automatically, your brain never codes it as money you had. It just adjusts. Step 4, the investment strategy. All right, so you've got money going into your 401k and your Roth IRA. Now the question everyone asks, what do I actually invest in? This is where people overcomplicate things. They start researching individual stocks, trying to find the next Apple or Tesla, watching YouTube videos about options trading and cryptocurrency. And look, I'm not saying you can never invest in individual stocks, but if you're just starting out, here's the strategy I'd follow. I would put 100% of my investment portfolio into a total stock market index fund, something like VTSAX if you're with Vanguard or FSKAX if you're with Fidelity. These funds own thousands of companies across the entire US stock market. You're buying a tiny piece of Apple, Microsoft, Amazon, Walmart, literally thousands of businesses all in one fund. The expense ratio on these funds is typically around 0.03%. Meaning for every $10,000 you invest, you pay $3 a year in fees. Compare that to actively managed funds that charge 1 to 2%, which would be $100 to $200 per year on that same $10,000. Now, you might be thinking, but what about diversification? What about international stocks? What about bonds? And here's my take. If you're under 40, you don't need bonds. Bonds are for wealth preservation, and you're in wealth accumulation mode. You want growth. As for international diversification, the total stock market fund already gives you significant international exposure because US companies earn about 40% of their revenue from overseas. Apple sells iPhones in China. McDonald's operates in over 100 countries. You're already globally diversified. This is where it gets really interesting. There's this famous study by Vanguard that analyzed investor returns from 2000 to 2020. The average investor earned 2.9% annually. You know what the S&P 500 earned during that same period? 7.4%. So the market itself did fine. Investors just couldn't help themselves. They bought high, sold low, panicked during crashes, chased hot stocks, and destroyed their own returns. The solution? Buy the whole market, hold forever, and stop trying to be clever. Step 5. Increasing contributions. Here's what separates people who retire wealthy from people who retire broke. It's not investment returns, it's contribution rate. Let me show you the math. Person A invests $300 a month for 40 years and earns a 10% average annual return. They end up with $1.9 million. Person B invests $500 a month for 40 years at the same 10% return. They end up with $3.2 million. The difference between $300 and $500 a month is just $200. That's like 4 or 5 fewer restaurant meals, 2 fewer streaming subscriptions, 1 less online shopping spree. But over 40 years, that $200 difference is worth $1.3 million. So here's what I do. Every time I got a raise, every time I got a bonus, every time I paid off a debt, I'd increase my investment contributions before I increase my lifestyle. This is called lifestyle creep prevention. Most people do it backwards. They get a $5,000 raise, they immediately upgrade their apartment, buy a nicer car, start eating out more, and suddenly they're not saving any more money than they were before. The raise just evaporated into lifestyle inflation. Instead, if you get a $5,000 raise, take half of it, $2,500, and increase your annual investment contributions. You still get to enjoy $2,500 of improved lifestyle, but you're also building wealth simultaneously. Look, here's the brutal truth that nobody wants to hear. Investing is boring. It's supposed to be boring. If your investment strategy is exciting, you're probably doing it wrong. There's this concept in behavioral finance called hyperbolic discounting. Basically, our brains are wired to value immediate rewards way more than future rewards. We'd rather have $50 today than $100 in a year, even though waiting is clearly the better choice. This is why people struggle with investing. You're sacrificing something tangible today, that vacation, that new phone, that night out, for something abstract in 30 years. Your brain hates that trade-off. But here's what most people don't realize. The sacrifice gets easier and the rewards get bigger. In year 1, investing $500 a month feels impossible. By year 5, it feels normal. By year 10, you're looking for ways to invest more because you've seen your account grow to 6 figures and you're obsessed. And the math gets wild. In your first year of investing $500 a month, you'll contribute $6,000. And with returns, maybe you'll end the year with $6,500. Cool, but not life-changing. But in year 30, if you're still investing that same $500 a month, your account might grow by $80,000 that year because of compound growth. You contributed $6,000, but your money made $74,000 for you while you slept. That's the power of patience. Before I wrap this up, let me tell you what I would absolutely not do if I were starting over in 2026. Number 1, I would not try to time the market. I don't care if people are saying the market is overvalued. I don't care if there's a recession coming. I don't care if some guru on Twitter is predicting a crash. You know what happens when you wait for the perfect time to invest? You wait forever. There's data on this. Fidelity did a study comparing 4 investors. One who invested at the market peak every single year, the worst possible timing. One who invested at the market bottom every year, perfect timing. One who invested consistently, regardless of market conditions. And one who just held cash. The results? The perfect timer and the consistent investor ended up almost identical after 20 years. The worst timer still did pretty well. And the person who held cash got destroyed by inflation. Consistency beats timing every single time. Number 2, I would not invest in individual stocks until I had at least $100,000 in index funds. Individual stocks are not how you build wealth. They're how you gamble with wealth you've already built. There's a massive difference. Number 3, I would not listen to financial gurus selling courses on day trading, options, strategies, or crypto schemes. If someone's trying to sell you a get-rich-quick system, run. Wealth is built slowly, consistently, and boringly. All right, let me bring this all together into a simple action plan you can start today. Step 1, Open a high yield savings account and save $1,000 as fast as possible. Step 2, contribute enough to your 401k to get the full employer match. Step 3, open a Roth IRA and set up automatic monthly contributions of whatever you can afford. Step 4, invest everything into a total stock market index fund. Step 5, increase your contributions every time you get a raise or pay off a debt. That's it. That's the entire strategy. No stock picking, no market timing, no complexity, just consistent investing in a diversified index fund for decades. If you do this, if you actually follow through and stay consistent, you will retire wealthy. Not maybe, you will. The math guarantees it. Here's the thing I wish someone had told me when I was starting out. You don't need to be smart to get rich. You need to be consistent. You don't need to understand options, pricing, models, or technical analysis charts. You need to set up automation and not touch it for 30 years. The people who retire with millions of dollars aren't investment geniuses. They're just people who started early, contributed consistently, and didn't panic when the market dropped. You can be that person. The only question is whether you'll actually do it. If this video helped you understand how to actually start investing in 2026, do me a favor and hit that thumbs up button. Subscribe to the channel if you want more straightforward financial advice without the hype and nonsense, and drop a comment below telling me what's been holding you back from investing. I read every single one. Thanks for watching, and I'll see you in the next video.